A loan trap. It sounds innocent enough. Borrow money to build a brighter future. But what happens when the terms are predatory, the interest rates exorbitant? What happens when the loan becomes a chain, shackling a nation to insurmountable debt? This is the dark side of easy money, the hidden dangers of loans that promise prosperity but deliver despair. This essay delves into the murky waters of loan traps, examining the concept of debt trap diplomacy, DTD, and its alleged role in ensnaring developing nations. We'll journey through the experiences of countries like Pakistan, Sri Lanka, and the Maldives, grappling with the complexities of high-interest loans, ambitious infrastructure projects, and the geopolitical maneuvering of powerful nations. The allure of easy money is powerful, but the consequences of falling into a loan trap can be devastating. Join me as we explore this critical issue and its implications for the global financial system. Pakistan, a nation grappling with economic challenges, finds itself deeply entangled in the web of Chinese loans. The centerpiece of this entanglement is the China-Pakistan Economic Corridor, CPEC, a sprawling network of infrastructure projects touted as a game-changer for Pakistan's economy. However, the CPEC has also become a symbol of the potential pitfalls of loan-driven development. Pakistan's debt to China has ballooned, raising concerns about the sustainability of its debt burden. The high interest rates on some of these loans have further exacerbated the situation. Critics argue that the CPEC epitomizes the risks of debt trap diplomacy, where loans are used as leverage to advance geopolitical interests. They point to the potential for China to gain control of strategic assets in Pakistan if the country defaults on its loans. This case study highlights the complex interplay between economic development, debt diplomacy, and national sovereignty. The CPEC is just one piece of a much larger puzzle, China's ambitious Belt and Road Initiative, BRI. Envisioned as a modern-day Silk Road, the BRI aims to connect China with Asia, Europe, and Africa through a vast network of infrastructure projects, including roads, railways, ports, and energy pipelines. While the BRI holds the promise of economic development for participating countries, it has also drawn criticism for saddling them with unsustainable debt burdens. Critics argue that the BRI is a tool for China to project its economic and geopolitical influence across the globe. The BRI's impact is being closely watched by policymakers and analysts worldwide. It raises fundamental questions about the role of debt in international development, the balance of power between China and other nations, and the future of globalization. The International Monetary Fund, IMF, has long been a lender of last resort for countries facing economic crises. But what happens when those crises are exacerbated by loans from other countries, particularly those with geopolitical ambitions? This question lies at the heart of the debate surrounding the IMF's role in addressing the debt challenges faced by countries like Pakistan, Sri Lanka, and the Maldives. Critics argue that IMF bailouts often serve to rescue creditors, including China, rather than the countries themselves. They contend that IMF loans should not be used to repay debts incurred through opaque or predatory lending practices. The IMF's involvement in these situations raises complex questions about debt sustainability, moral hazard, and the responsibility of international financial institutions in a rapidly changing global landscape. Section 5: Sri Lanka, a cautionary tale of debt and default. In the heart of the Indian Ocean lies Sri Lanka, an island nation grappling with the crippling consequences of a sovereign debt crisis. Sri Lanka's experience serves as a stark warning about the dangers of excessive borrowing, particularly when coupled with poor project management and external shocks. Once hailed as a development success story, Sri Lanka found itself on the brink of economic collapse, defaulting on its external debt and struggling to pay for essential imports. The country's debt crisis has been attributed to a combination of factors, including high-interest loans from China, ambitious infrastructure projects that failed to deliver expected returns, and the COVID-19 pandemic's devastating impact on tourism. Sri Lanka's plight underscores the fragility of economic progress and the urgent need for responsible lending and borrowing practices. Section 6: The Maldives, drowning in a sea of debt. The Maldives, a paradise archipelago in the Indian Ocean, is facing its own debt crisis, albeit on a smaller scale than Sri Lanka. The country's debt-to-GDP ratio has soared, raising concerns about its ability to service its external debt. Like Sri Lanka, the Maldives has been a major recipient of Chinese loans, primarily for infrastructure projects. These loans have fueled economic growth but have also raised concerns about debt sustainability and potential dependence on China. The Maldives situation highlights the vulnerability of small island developing states, or SEDES, to debt distress, particularly in the face of external shocks such as climate change and global economic volatility. Section 7. Debt trap diplomacy, a geopolitical strategy or a misnomer. The term debt trap diplomacy has gained traction in recent years, particularly in the context of China's lending practices in developing countries. It refers to the alleged strategy of using loans to gain leverage over borrower countries, potentially leading to economic dependence or even control over strategic assets. While there is no doubt that China's lending practices can be opaque, and that the country has used debt to advance its geopolitical interests in some cases, the concept of debt trap diplomacy is not without its critics. They argue that it oversimplifies the complexities of international finance and ignores the agency of borrower countries. The debate over debt trap diplomacy highlights the need for greater transparency in lending practices, as well as the importance of borrower countries conducting thorough due diligence and negotiating favorable terms. Section 8. Borrower beware. Agency and accountability in loan agreements. While lenders bear responsibility for ensuring that loans are provided responsibly and transparently, borrower countries also have a crucial role to play in avoiding debt traps. This includes conducting thorough feasibility studies, negotiating favorable loan terms, and ensuring that borrowed funds are used effectively and transparently. Too often, corruption, mismanagement, and a lack of transparency undermine the potential benefits of development assistance. Borrower countries must be held accountable for their role in ensuring that loans are used for their intended purpose, to improve the lives of their citizens. Ultimately, both lenders and borrowers have a shared responsibility to ensure that loans contribute to sustainable and equitable development. Section 9. Navigating the labyrinth towards a more equitable global financial system. The challenges posed by loan traps, debt diplomacy, and unsustainable debt burdens are complex and multifaceted. Addressing these challenges requires a concerted effort from all stakeholders, including lenders, borrowers, international financial institutions, and civil society. We need greater transparency in lending practices, more equitable loan terms, and a stronger commitment to debt sustainability. We also need to strengthen the capacity of borrower countries to manage debt effectively and to negotiate favorable loan agreements. Ultimately, we must strive to create a more just and equitable global financial system that supports sustainable development and empowers all nations to achieve their full potential.